Numbers don't panic, people do. Let's look at the psychology driving the market. We often build diversified portfolios, assuming that spreading our capital across different assets protects us from unexpected losses. However, this protection can fail when the crowd begins to herd. When investors follow the same popular narratives, supposedly independent assets begin to behave in highly synchronized ways. As herding behavior spreads, it creates a hidden concentration of risk. Investors believe they are holding diverse exposures, but they are actually participating in a single crowded investment story. Notice the distinction. Diversification is not just about holding different asset names. It requires that the underlying decisions driving those assets are shaped by independent calculations rather than shared stories. When social proof becomes the primary guide for allocation, the crowd converges on similar choices. This convergence creates a synchronized market environment where traditional risk boundaries slowly dissolve. How can a diversified portfolio still fail when everyone is following the same market story? The answer lies in how narrative correlation overrides traditional mathematical asset class boundaries. The core problem is that herding causes different assets to share the same psychological risk factor. When investors crowd into popular sectors, they link those assets to a single narrative. When sentiment shifts, these herded assets respond to the same emotional contagion. Rather than falling independently, they decline together as participants attempt to exit their crowded positions simultaneously. This coordinated reaction is consistent with behavioral herding. The social proof that made the assets attractive during quiet times becomes the mechanism that synchronizes their decline during stress. Under these market conditions, traditional risk models fail. They rely on historical correlations that assume independent participant decisions, ignoring how collective stories can rapidly synchronize the crowd behavior. The observable consequence is a sudden collapse of diversification benefit when it is needed most. Portfolio assets that moved independently for years suddenly fall in lockstep, catching herded investors unprepared. Look at this feedback loop. Shared narratives drive herding. Herding increases correlation. Rising correlation invalidates diversification models, and the resulting losses force further synchronized selling across the portfolio. To understand this, we must define narrative correlation. It is the alignment of asset price movements driven by a shared crowd story rather than by overlapping business fundamentals. Now, this correlation remains hidden during market expansions. When liquidity is abundant, herded assets rise together, and participants mistake this upward coordination for genuine, resilient, and reliable diversification benefits. This mistake is reinforced by social proof. Investors look at their peers' portfolios and replicate their allocations, assuming that collective participation is a reliable signal of safety and analysis. This replication is a form of behavioral contagion. The narrative spreads through news and online platforms, coordinating the crowd's expectations and driving them into similar crowded investment trades. We must distinguish fundamental diversity from behavioral diversity. You can hold different industries, but if all those assets depend on the same cheap leverage story, they share a single vulnerability. This shared leverage story is crucial. When volatility rises, participants who borrowed to buy these assets are forced to liquidate their holdings to meet margin calls and protect capital. This forced liquidation synchronizes the sales. The investor cannot choose which asset to hold. They must sell whatever is liquid, transmitting the stress from one asset class to another. This transmission of stress reveals the illusion. The diversification that looked robust on paper collapses because the participants holding the assets are bound by the same behavioral constraints. The core mechanism begins when social proof coordinates the crowd into a set of popular assets. These assets can represent different sectors, but they share a single narrative-driven investor base. As more herded participants join the trade, the asset correlations begin to change. The independent price movements that defined these assets in quiet times are gradually replaced by synchronized momentum. This momentum is driven by narrative feedback loops. Rising prices validate the shared story, attracting more capital and further coordinating the crowd's positioning across these supposedly diverse holdings. When a disruptive event occurs, it challenges the shared story. This disruption creates cognitive dissonance among herded investors who must quickly reassess their crowded position exposure under stress. To resolve this dissonance, participants seek to reduce risk. However, because they hold similar narrative-driven positions, they all identify the same assets as candidates for their immediate liquidation. This coordinated exit creates a sudden and severe liquidity bottleneck. As participants place sell orders simultaneously, prices decline rapidly, breaking the illusion of independent movement among these portfolio holdings. This synchronized drop triggers automated risk management models that require further selling. Automated systems reduce exposure across all assets, translating localized stress into a major market-wide correlation spike. Follow the liquidation cascade. Leveraged participants must sell their most liquid holdings to preserve capital. This selling pressure depresses the value of unrelated assets, synchronizing their price declines. This synchronization is consistent with reflexivity. The changing prices alter the crowd's expectations, replacing the calm diversification narrative with a single coordinated story of exit and capital preservation. During this panic phase, the historical correlations used in portfolio construction disappear. The diverse assets converge toward a correlation of 1, leaving herded investors exposed to systemic downside. This mechanism shows that herding makes diversification fragile. The more the crowd relies on social proof to select assets, the more those assets will behave like a single holding under stress. At the same time, the illusion is maintained by stable periods. When markets are quiet, correlations remain low, encouraging investors to take larger positions based on false risk metrics. This leverage buildup makes the eventual decompression more violent. The crowd is positioned for a diversified outcome, leaving no margin for safety when these asset correlations suddenly spike. This spike is not a random anomaly, but a direct consequence of herding behavior. It reveals that the crowd's search for safety through social proof actually creates the systemic risk. By failing to recognize this endogenous mechanism, herded investors remain vulnerable. They continue to build portfolios that appear diverse on paper but are behaviorally unified under market stress. To evaluate this model, we must establish its boundaries. Not all herded markets experience diversification failure. Sometimes genuine fundamental differences between separate assets can resist this narrative synchronization. Under these conditions, assets with strong independent cash flows may hold their value even when the broader herded market is unwinding, representing a clear limit to behavioral contagion. Additionally, this behavioral analysis has limitations. It does not allow us to predict which specific assets will correlate most strongly during a panic, as market liquidity dynamics vary. One key distinction is between passive index herding and active allocation. While index investors own everything together, active managers with strict independent mandates can still maintain diverse positions. We must also note that herding can sometimes stabilize markets. When a strong institution coordinates buying behavior, it can prevent panic, showing that synchronization is not always destructive. However, historical examples like the 2008 financial crisis provide a validating case. Supposedly diverse mortgage-backed securities fell in lockstep because they shared the same behavioral and leverage risks. By defining these boundaries, we clarify our focus. We are analyzing a specific mechanism where shared narratives coordinate positioning rather than dismissing the concept of portfolio diversification entirely. This brings us back to our opening question of how diversified portfolios fail under herding. The answer lies in the shared behavioral risks that unite supposedly separate assets. The herding pattern creates a narrative correlation that overrides traditional mathematical boundaries. The crowd coordinates their allocations based on social proof, concentrating their risk in a single story. By recognizing this mechanism, we can see that true diversification requires independent behavior. We must look beyond asset names and analyze the crowd positioning and narratives behind them. This insight allows us to build more resilient observation frameworks. We look past the low historical correlations and ask whether our assets are held by the same herded crowd. Rather than assuming safety in numbers, we evaluate the independence of each investment thesis. We check if our choices are guided by social proof or by fundamental analysis. Notice the distinction. We are not suggesting that diversification is useless, but that it becomes an illusion when the crowd herded into all the assets shares the same expectations. When a portfolio is behaviorally correlated, it lacks the resilience to absorb shocks. The system is vulnerable because a single narrative shift can trigger a synchronized unwind across holdings. By studying this narrative psychology, we learn to treat consensus with skepticism. We recognize that when everyone agrees on a set of assets, those assets share a single vulnerability. Target the mechanism, not the label. The goal is to understand how social proof coordinates crowd behavior, so we can identify the hidden concentrations in our observation frameworks. In practice, we can monitor herding by tracking changes in asset correlation during calm periods. A rising correlation among diverse sectors suggests that a common narrative is coordinating behavior. We can also study the investor base of our assets. When we find that the same funds and retail groups own all our holdings, the behavioral risk rises. Another practical step is to seek out counter-narratives. For each asset in your framework, identify the stories that challenge the consensus and evaluate the evidence for those stories. These observation steps do not replace traditional portfolio metrics. They represent an analytical tool designed to help us recognize when herding is making our diversification strategy fragile. We must also check if our choices are driven by fear of missing out. This emotional contagion is a key indicator of herding, signaling that risk is rising. Avoid using correlation observations as trading signals. Knowing that herding is active does not tell us when the synchronized unwind will begin, nor does it guarantee price direction. Keep our focus educational. By studying these behavioral patterns, we aim to understand how collective beliefs shape market structures, rather than attempting to predict short-term price movements. Consult professional financial advisors for portfolio management. Our goal is to analyze the psychological mechanisms of herding, rather than offering specific asset setups or trading recommendations. We must look beyond the diverse list of assets and analyze the crowd behavior that links them. Don't follow the herd, study it. See you next time.